Good evening, IBC. Welcome to the Laughing Crow Update. My name is Penny Pixel and I am your host. From the article, The Year the Financial System Stopped Working, on the International Herald Tribune website, I quote, "Long-term interest rates are at their lowest levels in half a century. Long-term interest rates are at their highest levels in nearly 20 years. This is shaping up as the worst year in 7 decades for the stock market. Of the 10 best days the stock market experienced during those 70 years, 6 came in 2008. The Wall Street legend who became a hero for forcing Wall Street to treat investors better, now admits to defrauding the later generation of investors of $50 billion. A prominent lawyer is said to have embezzled hundreds of millions by selling phony securities to hedge funds. The economists are worried about deflation. They are also fearful of inflation. The U.S. government is lending money to businesses that never could have borrowed from it before. People fear a wave of corporate bankruptcies as companies find they cannot borrow money to repay loans that are due. This was the year the financial system stopped working. Nearly all the contradictory but accurate statements above can be traced to that fact. Furthermore, it states, to the contrary, banks trusted neither their own balance sheets nor those of other banks. For a significant part of the economy, the government became the lender of first and only resort. For most of 2008, the Federal Reserve and the U.S. Treasury failed to realize that the banking system faced a solvency crisis rather than a liquidity crisis. Efforts to provide liquidity proved ineffectual because no one had confidence in the values of enormous amounts of derivatives and securitizations that the banks owned. No financial market can function normally when basic information about the solvency of market participants is lacking, wrote Michael Bordo, an economist who teaches at Rutgers University. In Greg Robb's latest article, Data will contain nothing but coal this week. He writes, durable goods orders are expected to have another significant decline as business caution has postponed any capital spending. New home sales should drop to the lowest level since the 1981-82 recession, and consumer spending should drop for the 5th month in a row. The single most important indicator will come on Wednesday, with the release of the durable goods report for November. Orders are the start of the economic engine and can give clues to the strength of the economy in coming months. Economists forecast that orders for big-ticket items will drop 3.0% in December following a 6.9% decline in October. New home sales are expected to fall 7.6% to 400,000 units. This is a level not seen since the severe downturn in the early 1980s. Home sales have rarely fallen below the 400,000 level, which is a threshold of extreme distress, Holt said. Consumer spending is likely to fall for the 5th month in a row. Economists expect spending to drop 0.7% in November, after a 1.0% drop in the previous month. What brought us to this current Armageddon-like crisis? John M. Barry argues in his article Recession Forecast Blown Up by Subprime Meltdown at the entire situation. That being the growing wave of defaults on loans, was made infinitely worse by the Treasury and its approach to deciding which companies would be helped and which would not. He writes, the September 15 filing for bankruptcy by Lehman Brothers Holdings Incorporated was the straw that broke the camel's back. Many parts of world financial markets, including lending among banks, froze. Within a few days, stock prices plunged, with the Dow Industrial Average tumbling from 11,388.44 on September 19 to 8,451.19 on October 10. The headlines and the actual loss of wealth shocked consumers, with the Conference Board's confidence index falling from 61.40 in September to 38.80 in October. As a result, the economy's mainstay, consumer spending, which at the beginning of the year I had counted on to keep the economy out of recession, led the way into it. Purchases of new cars and trucks, weak all year because of soaring fuel prices, dropped last month to the lowest level in 26 years. To compound the problems that Barry wrote about, and that the International Herald Tribune outlined, things are going to get worse in 2009. The IHT is reporting that while companies are seeking to reduce labor costs, few seem rushing headlong to reduce capacity. Matt Ritchell in his article, More U.S. firms cut labor costs without layoffs, says. To be sure, these efforts are far less widespread than layoffs, and outright pay cuts still appear to be rare. Overall, the average hourly pay of rank-and-file workers, who make up about 4/5 of the workforce, rose 3.7% from November 2007 to last month, according to the latest U.S. Labor Department data. Watson Wyatt, a consulting firm that tracks compensation trends, published survey data last week that found that 23% of companies planned layoffs in the next year, down from 26% that said they planned to do so in October. Companies say they are considering other cost cuts, like mandatory holiday shutdowns, salary freezes or cuts, 4-day work weeks and reductions of contributions to retirement and healthcare plans. Let us pause here a moment to reflect on the last point. And reductions of contributions to retirement and healthcare plans. The fact is that when a manager looks at an employee, it is often those contributions to retirement and health plans that push employees over the edge of being affordable. So, the bottom line is that while fewer jobs are being lost, the overall effect is that the jobs that are held are worth less holding. This is another deflationary aspect of the financial meltdown. In technical trading news, the QSIN-8 did not trigger a buy signal for Monday. That is all, and thank you from the Laughing Crow Studios deep in the icy frost of Canada.